Welcome to Slackin' Off with Brady Slack.
Welcome to another episode of Slackin' Off. I'm your host, Brady Slack. Today I'm excited because I have a couple questions for our guest, and we got connected through a mutual through a coaching group that we're a part of. So Alex and I have spent the last we get to spend a couple hours a week together, and then back and forth through some messages, keeping each other accountable. But thank you, Alex, for hopping on and wanting to be on the podcast. I appreciate it.
Yeah, 100%. This is my first ever podcast, so
there we go.
So yeah, I'm excited to see what happens here.
Are you nervous?
No, I don't think so. It's a conversation, right? So
yeah, that's good.
Yeah.
So tell me, Alex, why you wanted to be on the podcast. This is your first podcast. I feel honored because truth be told, podcasts they're newer for me, if you will. But tell me why you wanted to be on a podcast.
Well, I think I wanted to be on like your specific podcast because you obviously do a lot with taxes and like that sort of thing. Obviously, when it comes to like retirement planning and that sort of thing, taxes can be a pretty big sticking point for a lot of people. So, really to come on and have a conversation around like how, like when people are thinking about retirement, what are some ways that they can use life insurance to mitigate and or avoid taxes? So
okay,
there you have it.
We're diving right into it. So obviously for those listening today, Alex is he's a retirement planner. We're going to talk a lot about life insurance. I have my own questions about life insurance. Not from the standpoint of I don't know what life insurance is. I have a couple different insurance policies. In fact, I just had to renew one policy, and Alex helped me do that policy. It was a pretty easy process. But two, I think there's a stigma, if you will, around life insurance, in my opinion. And I'm going to apologize from the beginning. You might get just a little bit of heat because I do want to drill just a little bit into life insurance because I feel like there's a lot of people that give life insurance a bad rap. They're poor there's poor salespeople, and they don't write policies in the best nature of their client. Just my experience, right? So what? Why insurance? Why kind of this retirement planning mantra? Why insurance? What got you interested in that, or what made you decide to ultimately choose to go into insurance? If we can start there.
Yeah, sure. So just to tell a really quick, like super personal story. My dad passed away in 2018, and he and I didn't really have much of a relationship. So, he passed away from health complications due to alcoholism. But when he did pass away, it was sudden to me because I hadn't talked to him, for a long time before that. So, he lived in Boston at the time. My sister and I had to go up there to figure out what the heck happened. And, long story short, he didn't leave us with, anything that we know of anyway, at least not financially. And what sucked about it wasn't just obviously, my dad passed away. That's a relationship I won't ever have the opportunity to, try to repair. So there's that. But then there's also like, my sister and I had to come up with money out of our pocket that we didn't really have to, make sure he got, the cremation. And he was an army guy. So we wanted to make sure that he had like, that kind of proper service and that kind of thing. So, we had to come up with money out of pocket to do that. And, I have a family now. My family's not going to be in a position remotely close to that. And I don't want anybody else's family to be in a position similar to that either. Because there's a lot of, in that situation, there's a lot of questions of not only just like from the money aspect, like why didn't they leave anything behind, but also like, did my dad really care about us? Why did he do this? Like all those kinds of questions that, no child should ever have to ask of any parent, regardless of the situation. So I just don't want other kids, other parents to like wind up in a situation even remotely close to that is really why I got into life insurance.
Have you, we can look up statistics or something like that, but do you know if there are any statistics about how many people pass away where they pass on that financial burden to the family? Not that when someone dies, you're like, not that when someone dies, you're like expecting something from them financially, but
Yeah.
looking at the inverse of that is like, do you know if there are any statistics of people that pass away and the financial burden then gets placed on the people that are still living? Do you know anything? I'm
Yeah.
curious.
I'm sure there are plenty of statistics like that. I don't know them offhand, but I do know that, like cremation or burial, whatever the person wants, those can run anywhere from like 4,000 all the way up to like 20,000 plus. So like you're talking about, pretty significant financial burden on anybody that's left behind just to, you know, like cremate somebody or, put somebody in the
Pay for
ground.
pay for a
Yeah.
proper service. There's a
Right.
couple different kinds of insurance. You have kind of term, you have whole life, you have an indexed. I want to stick on just a term really quick. To be honest with you, so this is kind of where like you'll hear people talk about term life insurance versus whole life insurance, and you have people like Dave Ramsey who term, 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 shove it down your throat kind of deal. But I do want to stick on term because term is important. I think term is important, right? And term has its importance, much like your health insurance has its importance or your home insurance has its importance, and it's to secure an asset, you be or the individual being an asset. What kind of calculations should one do when determining what amount of term insurance to get? Because that is something that I've heard a lot of different opinions on, and I would love to know what your thoughts are.
Yeah. So, number one, you got to look at, your income. Cause I'm pretty sure you're the breadwinner in the family, right? At least for right now.
Mhm.
Yeah. So
Well,
you
my
got to
wife
look
makes a little
at,
bit, but it's for fun.
okay. Yeah. Right. Sure. So like if somebody is the primary breadwinner, or really if they provide any income to the house at all of any significant amount, like you got to look at that first, right? Because you're going to have to, like, you're either going to have rent, you're going to have a mortgage, one or the other. You're going to have bills and like that sort of thing. So you got to look at how much income you're potentially losing out on if you were to get sick or pass away. But then you've also got to think of, what's the time frame across which those expenses need to be paid if no other money's coming in, because you obviously can't cover those expenses indefinitely, because that
Sure.
would be a really expensive insurance policy. So you've also got to consider the time frame of which, like, how long can my wife, or how long, should my husband, if I were to leave them, how long could they pay these expenses, and how long could I have them covered until they find a job or find something else to get back on their feet financially.
And do you recommend that people, like, for example, if your total expenses in a year were $100,000 and you would anticipate a period of 18 months for someone to get back on their feet, are you suggesting that they only have an insurance policy for $150,000 that which would cover that kind of those expenses for that time frame, or do you recommend kind of securing an insurance policy with more money? The way that I've factored it, and you can tell me if this is right or wrong. The way that I've factored it is I've always utilized what your yearly income is multiplied by a factor of 10, and that's the amount of insurance that I'll cover just to make sure that, and it's probably overkill, but just to make sure that my family is covered. So if I'm making $100,000 a year, I want to be able to provide enough money for them to live with, at the current rate that we live on my salary for a period of 10 years, which would be a policy of about $1 million. Is that far off?
Yeah.
Tell me what your thoughts are.
Yeah, for sure. There's the thing with insurance that a lot of people don't realize is there's more than one way to skin a cat. So the way that you calculated that is perfectly fine. It sounded, based on what I heard from your thought process there, was you wanted them to be covered for 10 years, essentially. So now
Give
we're
or
getting
take, yeah.
back to that. Yeah, right. So we're getting back to that, like, how long do I want my family to be taken care of kind of concept, right? So factor number one is always income. How much am I need to replacing? Factor number two is always how long do I want somebody to, be covered. So if you just want them to be covered for a year, you make 150,000. Yeah, 150,000 will do that for you. If you want them to be covered for longer, then you're looking at obviously a higher, higher face value for your policy.
And does it get to a point in someone's life where you wouldn't recommend that they get life insurance? Like if I'm 72 years old and I'm fine medically, like would you still recommend that they get life? Like, I've
Yeah.
lived a good life. I'm fine.
Yeah. So the other thing about life insurance is it's not expensive when you feel like you don't need it. And then it's expensive when you actually do need it.
Yeah,
So when you get to, if you're somebody that's fortunate enough to be in good health when they're 72, you can still get insurance, but it's going to be way more expensive than it would have been if you would have gotten it when you were, 25, 30, however many decades younger.
sure.
Now, if you're getting into somebody that's like 72 years old, they're taking a bunch of medications for a bunch of different ailments, like there's probably not going to be a ton of companies that'll cover you for that. Just because, like, another thing a lot of people don't realize about insurance companies is that they are the best companies in the world at mitigating risk. That's the whole reason that they exist.
Because they want to make
So
money.
exactly. And, that's the whole reason that insurance gets more expensive when you get older, because you're more likely to need it. And therefore,
Yeah,
the insurance
there's more
company's
risk.
more on the hook for more money, because you're probably going to need that insurance money. And that's money that they won't have in their pocket.
Yeah, it's funny because the farther you dive into insurance, the more you realize that it's a game, and you have to play the game. But the reason it is cheap for those listening, the reason it is cheaper when you are healthy or when you are young is because there is inherently less risk that the insurance company takes on. So obviously, when there's less risk, they can be a little bit more free with their money. Um,
Yeah.
is there a certain length of time on a term policy that you recommend? 10, 15, 30 years? And why? Or I guess why would you recommend one or the other?
Yeah, it all depends on their age. So like for you, like you're 27, you'll be covered until you're 57. So that's a pretty decent chunk of time, a pretty
Yeah,
big window. If something were to happen to you, I would say probably the older that you get, you don't like, if you're 57, I guess you could be covered for 30 years, but it's more than likely going to be more expensive than something that's a shorter term. Because the shorter term that
sure.
you go, like we were just talking about, the insurance company is less likely to have to pay
That's
out
right.
that policy. So, um, so yeah, it all comes back to the guessing game of when you think something might happen to you. If you think something might happen to you within a shorter time window, then yeah, get a shorter term. But if you just want the peace of mind to be covered for as long a time period as possible, get a longer term.
Is there a situation in which you recommend someone doesn't get insurance?
Yeah, I would say anybody that's like a young professional that doesn't have a family, like the whole point of insurance is to leave something behind for somebody. If you don't have anybody that you're leaving behind, you don't need it, you know?
It's probably similar to, I guess, a trust still makes sense in that scenario, but not as much so as someone who does have like beneficiaries and people that they are paying out, because that is
Yeah.
you want to avoid from an estate standpoint the probate aspect of death. But I was curious if that does make
Yeah.
sense though with the death, and I'm enjoying this because I am learning something, and I hope others are learning as well. Let's switch over to more of like a whole life or an IUL. I'm gonna leave you at the floor. What's the difference? Is there a difference between whole life and an indexed universal life? What are those differences? What's your preference? What do you like more, or what are more of your clients doing and why?
Yeah. So as far as the difference so they're similar in the sense that they're both permanent products, meaning that you'll have the death benefit in place either until you die or unless you live to be 121. So if anybody's planning on living that long, I probably wouldn't get an IUL or a whole life.
Okay.
They're different in the sense, and they also have living benefits, meaning like I think you alluded to earlier, you have a cash value in those policies that compounds with interest that you can borrow against and use that money for whatever you want tax free because you're borrowing against the value of your policy. Now, the difference between the two when it comes to the compounding is depending on the company, but whole life generally will compound. It's going to compound at the same rate no matter what the stock market does. Usually it's about 4%, 4.5%, somewhere around there. So every single year, your cash value is going to go up by 4.5%. That's the most it could go up. And that's also the floor at which it'll go up as well. Now, with an IUL, you still have that compounding, but it's tied to an index of the stock market. So say like the S&P 500. Now, the great thing about IULs is that there's a floor of 0, meaning you're not going to lose any money like you would if you had that money in a 401k, IRA, etc. And you get, when the market comes up, you can participate in those gains tax-free without having to pay, like any, what's the word I'm looking for? Capital gains tax. You won't have to worry about that. But then also, those gains are capped at like 12%, depending on the company. So if the stock market goes up 30%, you're only making 12. So while the gains are capped, you're also not losing any money if the stock market were to go negative. So I know that was kind of a lot, but that's the main difference. That's how they're similar, but that's also how they're different in terms of whole life and IULs.
So based on that explanation, the IUL sounds much better because there's a higher opportunity there's a higher rate of return, but
right.
Why are whole life policies still potentially beneficial to someone? Like if you brought me both of those plans at face value, the IUL looks sexier, right? But what value does the whole life still have?
So the value of the whole life is that you don't have that 0 to 12% window. It's always going to be 4.5%. So it's going to look more like this, the growth is, as opposed to like, maybe this. Because when you get, like, if you're talking to somebody that, sells IULs, are going to walk you through an illustration, and that illustration is going to assume a certain rate that the market's going to go up every year. And we all know that the market doesn't go up every single year. Sometimes it goes up, sometimes it goes down. But you have, with an IUL, you're not going to lose any money, and you can still participate when the market does go up in terms of gains. So to answer your question of which I prefer, doesn't really, like, it depends on the person's situation. If they have less risk, if they have less, of a risk tolerance, like they don't want to go to 0, they just want to, do that 4.5% every single year, whole life probably would be better. If somebody wants to, it's kind of like a Honda Civic, dependable, what you're getting year in and year out, it'll last you a while. Sure. And the IUL is probably more like a sports car, where, it is going to be more expensive to have that kind of policy anyway, but you can have a lot more cash accumulation over a shorter period of time.
Now, with a whole life policy and an IUL, are the funding requirements to obtain access to the cash value of those policies similar, or are they different?
So as soon as you have cash value to access, which you should have with any type of policy after year 1, you can access it. So there's no, I think what you're getting at, like with a 401k and IRA, like that money's locked up until you're 59 and a half.
Right.
So there's no time period that you have to wait to access that money. You can access it. I mean, you can access it anytime you want, really.
And is that cash value based on the amount of money that I have used to fund the policy, or is there an inherent cash value just associated with the policy based on the value of the policy? Or does it have to be the money that I've put in I can access to give myself back?
So so say you're putting in like $100 a month, just to keep math simple.
Sure.
There's a portion of that that's going to go to the life insurance because it is a life insurance product. And then the rest is going to go to, like the life insurance portion would be like fees and like that sort of thing. But then the rest of the money is going to go into your cash value. So you won't have access to every single dime that you put in, but that's where compounding comes into effect. Because at some point you're going to break even on that policy. And then you'll be in the black in terms of the premiums that you put in. But even with IUL specifically, a lot of the fees and like that sort of thing are front loaded into the policy. So it's not going to look like, your cash value is doing anything for probably, depending on how you fund it, for a few years. But after, say, like year 7, 8, 9, 10, that's when you'll really start seeing it take off, assuming the stock market does what it's supposed to.
What it historically has done. So this is, and I apologize in advance, this is where I have the biggest holdup with insurances, and I would love to hear what your rebuttal is. Because if I if I open up an IUL and I've got to wait 5, 8, 10 years to access quote unquote 80% of the cash value that I put in, say it's been $100,000, I I still have like the death benefit aspect of that insurance policy, so there could be some benefit on the back end of that. But I could have much, in my opinion, I could have much better utilized maybe that $100,000 during that time frame to accelerate growth. Does that make sense?
Yeah. Yeah, no, absolutely. And this is where it comes into there's more than one way to skin a cat. So like for you, like you're a tax guy, so I would imagine that, you're fairly like your risk tolerance is very low, I would imagine. Is that accurate or no?
I actually have a really high risk tolerance.
Okay.
I'm only because I love the upside. That's I've
Okay.
taken
Fair
some
enough.
I've taken some nasty falls, but I've had some
Okay.
great opportunities.
Okay. Got it. Fair enough. So yeah, it all just comes down to the individual person and what they're looking like, what their goals are. So like yeah, there are people that if they put $100,000 into an IUL, they feel like they might be able to get that better spent elsewhere. So it's all dependent on the individual and what their
Okay.
plan, like retirement plan is now, where they want it to be, what they want the retirement income to look like when they do retire. So yeah, there's always more than one way to skin a cat. There's no right or wrong answer. It's just dependent on each person, what they're looking to get.
Okay. And no, you would have been right because most people in my profession are very, very risk averse. They hate risk.
Yeah.
They're
So
very,
sorry
they're
for
very
sorry for
easy.
stereotyping you, but that's just
that, that's okay. I kind of break that stereotype. I'm younger. I don't always wear like a button-up shirt, so
yeah,
it's okay. I don't
right.
follow that stereotype. Okay, that's a good overview of insurance. As far as like the technical side of insurance, is there anything else that
Yeah.
people should know about insurance that because we went pretty we went fairly technical there. So is there anything else technicality wise before we maybe get into the applicability of some of this stuff that people should know about or that you feel like is important?
Um, I don't think so. I think the main thing that I deal with a lot when it comes to insurance is like I'll get on the phone with somebody and they'll say, "Hey, can you just give me a quote?" It's like, "Yeah, I can give you a quote. What am I quoting?" You know what I mean? So like, for you, like an IUL might not work for you. I could give you an IUL quote all day long, but if you're not happy with how it, either accumulates cash or the death benefit, et cetera, like why would I quote you an IUL? Like it might make
Doesn't
more
make
sense
sense.
just to do, yeah, like if you're just looking to take care of your family for a certain period of time, then let's look at a term. Or if you're somebody that's really old and haven't had any insurance, let's look at like a final expense policy that's going to be guaranteed until similar to a whole life, just for a smaller amount. So yeah, there's more than one way to skin a cat. It's entirely dependent on everybody's situation.
You keep referring to the aspect, like you keep using the analogy, there's more than one way to skin a cat. And it's funny, um, I was in an interview for a Forbes magazine article this morning, and the ghostwriter, the content writer who I was doing my interview with, just kept telling me or referring to um, this this financial advisory space, whether that be insurance or retirement accounts or tax, whatever that might be, maybe even attorneys you could loop in. Um, there's there's so much information. And my comment to
Yeah.
her, and I see the similarity with the insurance, is there's so much financial porn that I think people are often inundated with information that does not apply correctly to their situation. Um, how how does this impact the insurance industry? Both those who are looking for insurance and then as an advisor as well.
Yeah. So there's a lot of IUL influencers right now, like on TikTok, you name it, wherever. And, you know, there's even a lot of agents, they don't have to be influencers. There's just a lot of people that, say, hey, IUL will fix all your retirement issues. If you're behind the eight ball, get an IUL, which is true to a certain extent. But if you're talking to somebody that maybe doesn't make as much money per year and they can, they're barely getting by in terms of saving money now, and they can only put in $100 a month, well, then an IUL probably isn't going to be the solution for them. But unfortunately, there are a lot of people that, that say that something like that is. But with a lot of what people don't realize about an IUL and why IUL gets a bad rap is that, yeah, there are fees, but you pay like the fees make up, or the cash accumulation kind of makes up for the fees that you wouldn't see with a whole life or really most other investment vehicles. So yeah, you're 100% right. There is a lot of like misinformation, just outright dishonesty. So yeah, in terms of like how to overcome that, I don't really have a good answer. Like to a certain extent, yes, people do have to be mindful of like what they're looking into. And like, yeah, I would absolutely do some research on what you're getting into beforehand, take everything with a grain of salt, and, really work with somebody that you trust. How do you figure that out? Well, talk to somebody that's, wanting to know, like, have the picture painted of your entire situation so they can fit a custom solution into what you're doing versus trying to fit a square peg into a round hole.
I've learned over time to follow the money, if you will. And you can either deny or confirm or neither what I'm about to say, but in insurance, and this is probably a reason why you have so many of these people touting the IUL, because they get the highest commission on an IUL. So sometimes they're not always going to build that policy with you in mind. They are going to build that policy with them in mind, to try and get that. And again, that's the other hard part that I have about the IUL, just personally. It's nothing against insurance. Again, like I said, I have multiple policies of insurance, both for me, my spouse, business partners, kids. So I'm pro insurance, but that's, again, follow the money. So I think when it comes to insurance, the recommendation that I would make before we dive into some applicability and some different situations that we've seen, the recommendation I would make is to find the advisor, find that member of your team, make sure that you trust that member of your team, that they're going to explain things thoroughly, contracts, overviews, payment, fee structures. And this isn't just necessarily for IUL too. I would also make that recommendation when you're going to work with an accountant or an attorney or a retirement planner who does, qualified plans, things like that, because there's always going to be a fee structure, and you always want to know what you're paying for. But you also want to know how they're making money. They've got to make money. They got kids to feed, food to put on the table, a roof over their head. So, but you're going to want to work with the ones who do it most ethically. That is my number one opinion right there. I don't know if you have any thoughts to add to that.
Yeah, no, I agree 100%. Anybody I've talked an IUL with, like the way that the illustration softwares are set up by default, they do not include information about the fees. And in my opinion, like if you're an insurance agent out there and not telling your potential clients about whatever fees they'd be paying, like stop doing that. Like that's not right. It's not fair. Like you could even say it's like borderline illegal. But I always include that. I always make sure to go over it with people. And I'm not saying that because of like I want to be self-righteous or anything, but it's important for me, for people to understand like what exactly they're getting into. And, an IUL can be painted as like a fairy magic pill will solve all your problems, but you also need to know like what you're getting into, like when it comes to that, at least from my perspective.
No, I agree with that. Let's go into kind of the applicability of this situation. You shared a kind of a really, you shared a close story with yourself, and I'm sorry about the passing of your father. That's never a fun thing to have to go through. What other stories do you have from clients, or other people in your industry where to kind of highlight the importance of this insurance, life insurance in whole as a whole, if you will?
Yeah, I don't have any specific stories, but I mean, if you just do any Googling, like you could see all kinds of stories of like somebody that took out a policy when they were like 30, 32. And then when they turned 40, like they all of a sudden got terminal cancer and, they unfortunately passed away. And, maybe they had a good job, maybe they didn't, but they had that safety net of insurance to where, not only your kids, and your spouse or whoever you're leaving behind, like they're taken care of, and like they're not just, kind of left. Like my sister and I were like, what just happened? Like, now what are we going to do? You know what I mean? So there's all kinds of stories, like that out there if you wanted to find them.
It's funny. There was a news article that was just released here in Utah. I actually know the family. I don't know the individual. I know the family, but this lady, her and her husband had been married for a couple years, and he had died, but the toxicology report said that he died of a fentanyl overdose. Well, it came back later, and she was just charged for first-degree murder, and they're saying that she
Yeah.
killed her own husband. And it's funny. It's not funny. That's a very sad story. I'm just saying it's funny because you'll hear some of these stories every now and then, and you'll always hear that a week or a month or a time period before this person had passed away, there was all of a sudden 2 or 3 extra life insurance policies that had been taken out on the individual, right? Without maybe them knowing. And I just that's the funny part, because it's like, okay, like what other purpose would you have for taking out a life insurance policy if you've already had a couple, maybe they were already even owned by your trust, and all of a sudden this person dies? That's a little suspicious, if you will. So that reminded me of that story.
Yeah, there's always, I'm sure there's a bunch of Lifetime movies about that exact scenario. So you could find those if you wanted to.
Nope. How do you work with clients and their other financial advisors, whether that is a tax planner or an investment advisor, about implementing insurance into their plan or their strategy? How do you work with clients on that?
Just have a conversation with them really about what they're looking to do, like what they envision, like a more like a cash value living benefit type of insurance, how they envisioning that benefiting them. A lot of times, a very common scenario I run into is somebody has, some money in like a 401k or an IRA that they're not happy with how it's performing, understandably so, considering the stock market went down, 20+% last year out of nowhere, basically.
Yeah.
So, people who are less risk tolerant say, hey, I don't like the ups and downs of the stock market. Let me put it into an IUL. Well, or something like that. Doesn't have to be an IUL. Well, there's obviously going to be penalties and tax implications with that, because the IRS looks at that, 401k withdrawal as income. So, now if they have a tax advisor, we've got to look and see, are they going to get bumped up tax brackets? What's their tax burden going to look like if they do make this move? Is it better if they just contribute monthly into the IUL? There's all kinds of moving parts. So if somebody has like a tax advisor or a financial planner, like, yeah, let's talk, see how we can make it work, kind of thing. It's like, my wife's a doctor, so I'll use this analogy, but like she talks with nurses, she talks with other providers like neurosurgeons and that kind of thing, as far as like what the best plan of action is. So it's very similar to something like that. Like everybody has to be on the same page. It's very collaborative.
Their team. I call it the team.
Yeah, exactly.
What about and I'll add kind of my 2 cents on the back end of this, based on what we do with our clients when it comes to insurance, and what I know some other advisors that I know do. What about like estate planning, trusts, wills, different things like that? How do you incorporate those into your clients' plans?
Yeah, so same kind of thing, just having a conversation, see what they're envisioning this doing for them. I haven't encountered an estate or trust situation yet, so I don't have a good answer for you there, unfortunately. But as far as the process, like it would essentially just be the same, like just collaborate with whoever needs to be collaborated with on what needs to happen. Like what are some potential ramifications of doing this? Also the opposite way, what are some potential ramifications of not doing this? Just so that way everybody's on the same page.
I'll use myself as the example. So in the past, I've had insurance policies with business partners, just in case something happens. Like there's a lot of value that either one of us provide to the business. And if something were to happen, we'd have to have those cash reserves to be able to supplement while the other person was gone, and then rehire someone to fulfill that role. So those are situations in a business where an insurance policy might be beneficial, to ensure you probably being the most important asset in your business, or a partner. Um, Me and my wife both have one to a few different insurance policies. Um, Based on how our income's grown, or what other assets we've accumulated. And although each of us are listed as a primary beneficiary, we also have insurance policies where our children are listed as the beneficiaries, right? And some of those policies are owned by our trust, okay? Or excuse me, the trust is listed as the beneficiary of those. That way, if something happens to both of us, that money then will be able to go to the trust, and our trustee will be able to direct what happens with those funds based on whoever's helping raise our two boys. And they'll be able to be provided for. Like I said before, I know if me and my wife were both to die today, heaven help my brother-in-law who'd have to raise our boys. They're great, but at this point, there would be well over seven figures of life insurance proceeds that would go to this trust, and my dad, who happens to be the trustee of our trust, would help direct those funds and make sure that our boys are provided for. It would not cause a financial burden to those who have to help raise them. So that, again, just a couple important aspects of what that might look like. And again, me and my wife didn't even consider getting insurance policies until we had children, because we didn't have beneficiaries. We had no need to do that. We were both younger, and we had enough money in the bank to where if one of us would have died, we would have been able to cover the funeral costs, and we were both working. So those few situations in everyone's circumstance play a part as to how you go and skin a cat, if you will.
Yeah, 100%.
Good. Any other thoughts, Alex, on insurance? Anything that we missed that you would want people to know? I guess, and this is where I'll put you on the spot, contact information. How can people get a hold of you if they have questions about insurance?
Yeah. So if anybody has any questions, they can just call me directly. 205-846-8226 is my number. So feel free to call, text, whatever works.
Cool.
But yeah, as far as insurance goes, don't wait. If you feel like you need some, just get some. If you don't want to go through, if you don't want to do something as expensive as, say, like an IUL or whole life, there is something like term that's cheap that you can have in a transitionary period until you want to get something more permanent. So there's a bunch of ways to do it. But yeah, cool. I would say don't wait if you feel like you need some.
Awesome. I would agree with that. Thank you again, Alex, for being on the podcast today. I hope all of you guys who are listening got a little bit of value from this. I know I learned a little bit more about insurance policies. I feel like they're very important. I will never say that they're not important. But I do feel like it does require a great deal of care as you apply it to your specific situations. So thanks for the walkthrough, Alex. For those listening, if you do have questions, please shoot me a message on Instagram. Leave us a comment. Like our podcast. That way others who are also interested in learning more can do so. And this was another episode of Slackin' Off, where we do everything but slack off. Have a great day.
Thanks for tuning in to Slackin' Off with Brady Slack.